Did you know that the average American pays nearly 30% of their income in taxes each year? That's almost a third of your hard-earned money. It's a staggering figure, isn't it? While taxes are a necessary part of our societal structure, there are completely legal ways to decrease the amount you owe each year. So wouldn't it be great to keep more of your income for yourself? Well, you can, and we're here to show you how. First things first, understand your tax bracket. You can't lower your taxes if you don't know what you're dealing with. Let's break this down. A tax bracket isn't as complicated as it sounds. It's simply the rate at which an individual is taxed. There are different brackets for different levels of income. The more you earn, the higher your tax bracket may be. But here's the catch. The US operates on a progressive tax system, which means not all of your income may be taxed at the same rate. Only the income that falls within each bracket is taxed at that rate. So if you're in the 24% tax bracket, for example, not all your income is taxed at 24%, just the portion that falls into that bracket. Knowing your tax bracket is crucial because it helps you understand how much you're paying in taxes and where you can potentially save. So, understanding your tax bracket is the first step. But what next? Let's dive in. Next up, deductions. They're not just for business owners or the self-employed. There are plenty of deductions that you might be missing out on. For instance, did you know that you can deduct certain medical expenses? Or that you could potentially write off your student loan interest? Even your charitable donations can be deducted. And let's not forget about the home office deduction. If you're working from home, a portion of your rent or mortgage could be tax deductible. The key is to keep track of these expenses throughout the year. Hold on to receipts, keep a record of your donations, and use a mileage tracker if you're driving for work. Remember, these deductions can significantly lower the amount of income that's taxable. So, be diligent and take advantage of every deduction available to you. By maximizing your deductions, you can significantly lower your taxable income. But there's still more you can do. Now, let's talk about tax-advantaged accounts. They're not just for retirement, and they can save you a ton on your taxes. These accounts, like 401ks and individual retirement accounts, or IRAs, offer significant tax benefits. When you contribute to these accounts, you're essentially reducing your taxable income. This means you could potentially fall into a lower tax bracket, thus saving you money when tax season rolls around. But that's not all. The money in these accounts grows tax-free over time. So all those dividends, interest payments, and capital gains, they're not taxed until you withdraw the money, often at retirement when you might be in a lower tax bracket. Sure, there are contribution limits and rules to follow, but the benefits are worth it. Investing in tax-advantaged accounts is a powerful way to lower your taxes. But don't stop there. There's always more you can do to keep more of your money. So there you have it, understanding your tax bracket, maximizing deductions, and investing in tax-advantaged accounts. We've covered a lot of ground today, and it's now your turn to put this knowledge into action. Start by understanding your own tax situation, then look for ways to maximize your deductions and make smart investments. Remember, the more you know, the less you owe. So don't forget to like, share, and subscribe for more tax-saving tips. Keep that money in your pocket, not Uncle Sam's.